In the wake of what we saw in Turkey over the past couple of weeks, we had a lot of volatility with the dollar, which was certainly at one point helping the bears, but certainly now with the weakness in the dollar, that is favorable for the oil bulls. We're also looking at a market right now that is really being kept afloat on headlines. Some of these headlines are old. Venezuela, it's in the final chapter of its Atlas Shrugged saga. Iran sanctions. Everyone knows those sanctions were coming up, but we do have some new headlines, of course. What we got out of Iran yesterday, threatening to choke off the Strait of Hormuz, that is certainly going to put a geopolitical bid into the market at this point. And some renewed civil strife in Libya is also helping to propel the market. But it's also important to, yes.
So overall, though, Stephen, on the geopolitical point, are you saying that that's already priced in net those issues, or that geopolitics could give a further boost for the rest of 2018 to oil prices?
Well, there's certainly, absolutely. If we all know it, if we all know the headlines, then in theory, it's all priced in, absolutely. So when you get a market like this that lives off the headlines, you need more and more headlines to feed it. But I want to keep in mind, and listeners should also bear in mind, that this is a market that's been extremely resilient. So on top of the geopolitics, at the beginning of the summer, we had the loss of Canadian imports because of a upgrader that went out in Calgary. So we lost a lot of imports there. We also know that in May, a recent report by the EIA told us that the state of Texas, the refinery epicenter of the United States, was exporting 500,000 barrels more crude oil than it was taking in. And yet the consumer at the pump received a 7% discount this summer relative to the last 5 years. So the consumer in price was unaffected. So while we do have these headlines, the market has been able to absorb these shocks and certainly keep the market well supplied. Now we're at the end of the summer. So we're at the, to go back to our high school calculus, that dy over dx moment where record demand this past summer will not transition into the fall. As refineries go into their maintenance season, they buy fewer barrels. Demand is taken out of the market. So if we are going to see any sort of pullback in price, I suspect it should occur over the next few weeks as this demand falls off. And let's keep in mind that come in October, we've got 11 million barrels coming out of the U.S. Strategic Petroleum Reserve that will make its way to the market. That will certainly help quell any sort of geopolitical headlines, because keep in mind, October is probably your weakest demand month for crude oil, and we're getting an 11 million barrel surplus to hit the market then.